Welcome to our bonus videos. And if you haven't seen all of our bonus videos, you might want to check those out because whether you're a buyer, a seller, somebody trying to get your real estate license or your broker's license, or maybe even trying to get your mortgage loan originator's license, we're here to help you understand everything you need to know about real estate. And today's class is really going to help you understand if you're a buyer, who you should get your mortgage loan through. And if you're a real estate agent or a broker, who should you be referring those clients to? Now, one thing I might want to say about if you're referring people, make sure you always give your clients a choice of referrals. Because if you just give them one person and they go to that person and it doesn't go so well, you could be hearing it on the backside. So you want to make sure that you let them shop around. So let me grab my material about mortgage brokers and mortgage bankers. And I can't say enough how I'm so qualified to teach you about this. I started as a processor at a mortgage company. I became a mortgage loan originator, started my own mortgage company with my brother. We became mortgage bankers. And then I went to work at a company, a large banking company. And then I came back full circle to being a broker. So let's talk about the difference between a mortgage broker, a mortgage banker, and going straight to a big company, like one of your major banks, Bank of America, Wells Fargo, Chase, whatever it may be. So let's talk about that. Mortgage bankers first. So, mortgage bankers are people who have their own warehouse line and they use their own money and they have their own underwriters and their own funders. And that sounds like it's a pretty good deal because they say, well, we make the decisions. Okay, but what if you don't like my client's loan? So, let's jump into it. Mortgage bankers. Mortgage bankers are mortgage companies and they like to service the loans that they make and sell them on the secondary market. So what does that mean? What they do is they sell it on the secondary market to Fannie Mae or Freddie Mac, and Fannie Mae and Freddie Mac are investors, so they don't service the loans. So the mortgage banker can still service the loan, meaning the new buyer is going to make payments to, let's say that you did your loan through ABC Mortgage Company, you're making payments to ABC Mortgage Company. But what they did was they sold it on the back end and they refurbished their warehouse line. But they also have their own underwriters, their own funders, they have their own processing department, and everything is what they call in-house. So a lot of times people will say, well, because it's in-house, we do everything quicker. Well, that's not necessarily true because you also have mortgage brokers. And mortgage brokers are people who don't have their own warehouse line, don't have their own underwriters. In fact, we don't even have our own funders. What do we have? We have awesome loan originators. A loan originator is the first person that your client talks to. So whether it's a loan originator at a mortgage broker firm, at a big bank, or at a small mortgage brokerage, they're all people who are there to help you through the application process. Now, mortgage brokers, like I said, they don't have their own money, so they go through wholesale lenders. And there's a ton of wholesale lenders. And another thing that I find interesting is sometimes when you're talking to somebody who's at a brokerage, they're like, oh, we're approved at 200 lenders. Well, that's not necessarily what you want to hear. You want to hear that they use maybe 3 to 5 particular lenders, because then those lenders are going to listen to them if they have a problem or if they need some help getting your loan through. So a mortgage broker uses wholesale lenders, and the mortgage brokers and the mortgage bankers and any loan officer is the first process or person that your client is going to talk to. And because of that, you want somebody that they can work with that understands their wants and their needs. Because when you're talking to a person, like as a mortgage broker, and I'm talking to somebody, I want to know, are you going to buy this condo? And then after you buy this condo, you're going to earn equity in it and you're going to sell it and buy your next home. That's your step up home. And then you're going to be in that one for a while and step up, and you're going to be selling properties on the way. Or are you going to do what's called pyramiding? Are you going to buy a property? This is what I did, by the way. Bought a property, a super small little 1 bedroom, 1 bath condo. In fact, one I didn't even want, because the one I wanted, interest rates went from 8 to 18%, and I didn't qualify anymore. And it was brand new. I watched it being built. But instead, I had to settle for something that I really didn't want. And that's what we're talking about in today's market, where a buyer should really, I'm not saying buy the worst thing in the world. I'm saying buy what you can and let it grow equity, because at least you get your foot in the door. And then what you can do is you can take the equity out and buy another property. Keep this one and rent it out. Buy that next property, live in that property for a while. Maybe take some cash out of that one and buy your next one, and on and on and on. People ask me how many properties they should own, and I always say, well, how many kids are you going to have? You should have one for every kid, because that way, when they grow up, they'll have something to fall back on. Because who knows what the market's going to be like when your children grow up, right? So, back to the mortgage bankers and mortgage brokers. So, mortgage bankers use their own money. Mortgage brokers use wholesale lenders, and then banks use their own money, of course. So they're the first people that your clients meet. So you know how I said we go to the secondary market where Fannie Mae and Freddie Mac are? Well, the loan officer, the originator, as we call them, mortgage loan originators, they're the first contact. So they're what's called the primary mortgage market. So you have to know that the backside, Fannie Mae and Freddie Mac, are the secondary market. That's where they buy and sell loans. And the front of the market is called the primary market. So in the secondary market, on the back end is where Fannie Mae and Freddie Mac make the rules and fund loans. But for the purpose of your state exam, FHA is not on the back end. Okay. So you have to know that they'll have Fannie Mae, they'll have Freddie Mac, they'll even add in Ginnie Mae. But the answer that you want to know is that FHA, that's the Federal Housing Administration, is not on the back end. But who is also on the back end is your insurance companies. Big life insurance companies. Big life insurance companies like to make money on loans, but they like to do big, huge loans, like for a $30 million shopping center. So you may be asked, who would be the least likely person to do this $250,000 loan or $190,000 loan? Well, the least likely person, of course, would be your insurance companies, because they want to work with the big money, like the big investments, like a $30 million shopping center or a big, huge hotel chain or something like that. They're not going to want to do the small loans. But to make sure that you understand why you might want to work with a different type of person. Now, your clients may want to go to their credit union or the bank that they bank with, and that's fine. They can. But a lot of times, depending on what they're offering, mortgage brokers can usually beat, most oftentimes can beat a big bank, but they can't usually sometimes beat a credit union. So it depends on what the credit union has that they're offering at any given time. There are some really great credit unions out there, and I actually know of some that will do some really good equity lines, and that's why we have so much information for you guys that all you have to do is ask us what you're looking for in our chat, and make sure you subscribe and you give me thumbs up, and we can answer all your questions of where you should shop and who might be the most likely person that could do your type of loan. And I'll give you a couple of really good examples why it's so important to work with somebody who knows what they're doing on the loan end. Because if a client comes to me and says, I'm only going to have this property, I only want it for 3 or 4 years, and I really don't think I want to keep it. In fact, I never want to be a landlord ever. Well, I'm not going to give them a 30-year fixed rate loan. If they have the money to get a different type of loan, I would offer them maybe a 3 or a 5 or a 7-year loan, because those loans are interest only. And because they're for a shorter period of time, they're lower interest rates than the 30-year loan. So it's interesting because most people think that the 30-year fixed rate loan is the best loan out there on the market. But you have to think about this logically. Whatever they're offering you on the 30-year fixed rate loan, if you get a 20-year fixed rate loan and you're qualified for that loan, you're going to get a lower interest rate by usually about a quarter, maybe even sometimes 3/8, which is significant. Yes, the payment's going to be higher if it's a 20-year loan, but your interest rate's going to be lower and you're going to pay less interest over the life of the loan. Because here in the United States of America, we pay the lender their interest first. So those of you who refinance over and over and over, and I've had clients that want to refinance over, and I sit in front of them and I go, you're just going to start all over giving the bank interest, because you pay the interest first and then you start paying down your principal. So one of the other things that you need to know about money and lending when it comes to a loan for a borrower is when they're making their payments at the beginning of the loan. And this is where you can see it. You can see it on the loan estimate. You always want to look at the loan estimate. And maybe I know I have a video for loan officers on how the loan estimate works, but I think I should probably do a really cool video on showing you a loan estimate and showing you what to look for, because there's one area where it says, okay, you've had your loan for 8 years or 5 years. There's a certain period of time. You've had it for this much. How much has your payments been? How much have you paid towards your payment? And you could have already paid maybe $50,000, but how much did your principal go down? $8,000, because the rest of it went to interest. So there's so much to teach you about loans and how loans work and what kind of loan is best for your client, because a lot of people don't know that there's different options. The other thing that people don't know about loans, and I was in the loan business for a long time before I believed it was even possible to have down payment assistance programs. And a lot of people don't know that FHA, the Federal Housing Administration, actually has a down payment assistance program that does not have an income limit. So most of the down payment assistance programs that you're going to be looking at will say you can only make X amount of money and you don't qualify. Well, the sad part is I don't know who shows them the qualifications, but if I only make this much, and that's how much I can cap out to get your down payment assistance program, then I can't even buy the house I want, because in order to buy the house I want, I have to make this much. But the other story I wanted to tell you was a true story about a young lady who went to a large bank. And she went to the large bank. She was more than qualified. It was her bank that she banked at. And she came into my mortgage office one day, and we had one of our loan officers. He was doing a lot of advertising to realtors, and he said, if your client can't get a loan, come to us. At least give us an opportunity before your client cancels out of the deal, even though they should have been pre-approved before they even went to the deal. However, what happened was the young lady came in. She was in her nurse's uniform, and it was lunchtime. And I looked at her and I said, "Hi, can I help you?" And she said, "Is this a mortgage company?" And I said, "Absolutely." And she said, "Well, my real estate agent told me I should come and talk to you guys before I decided to cancel my transaction." And I said, "Well, what's happening?" And she said, "Well, my sister and I are buying a house together, and we just got turned down." And I said, "Well, do you know why you got turned down?" And she actually told me no, she did not know why she was turned down. And they're supposed to tell you why you're turned down, but when you're in the middle of a transaction, they're not going to tell you. They should tell you right away why you're turned down. They legally have 30 days to tell you why you're turned down, but 30 days later, you're probably going to lose the house you're trying to buy. So I said to her, I said, "Well, tell me a little bit about it. How much is the purchase price?" And she said 800 grand. And I said, "Okay, how much is your down payment?" And she said, "We're putting down $400,000. And so here's where you're going to learn what you have to know about a buyer, and what the buyer needs to know if you're the buyer is that's 50% loan to value. That means I'm putting 50% down of the purchase price. So I'm only getting a loan of 50% of the value of the property. So, I specialize in doing first-time home buyers, but because usually people who have a lot of money will have money in their own mortgage, like securities, where they put their money in a place where they're earning a lot of interest, so they can pull from there on the bigger homes. So there's kind of the bigger homes like that, and then there's the small homes, and then there's the in between. I'll do any loan that I can help somebody with. So she's pretty much a middle loan. And I said, "Well, okay, so you're getting a loan for 400 grand, and you're putting down 50%. So the next two things I care about: your job history, how much money you make and how much money you spend, and your credit. So I need to know about your income debt ratios." Okay, income debt ratios. And I need to know about your credit. So I said to her, I said, "What about your credit?" And she said, "Well, my sister has an 820 credit score. Anything over 800 is golden." And I said, "Well, what about you?" And she said, "Well, I have a 775. And I said, "Well, if it's over 720, it's excellent." So right there, I got two out of the three most important things. And she's in a nurse's uniform. And I asked her, I said, "Are you a nurse?" And she said, "Yeah, both my sister and I are RNs." Well, I know that they both make money. So I'm thinking, what could be wrong with this loan? Do they have like a $1,000 car payment each, or what's going on? And she said, "We have no debt." I said, "All right, are you in your lunch hour?" And she said, "Yeah." And I said, "If everything you just told me is true, I can have your loan approval in 20 minutes. And so we sat down. and I put her loan information in. We can type it right into the information, and I can run the credit report and get it's called a desktop approval. And that I put it into the Fannie Mae, you could have either Fannie Mae or Freddie Mac. We were using Fannie Mae, and we uploaded in there, and I had her approval in 20 minutes. So the only thing that I could tell you as to why her bank didn't want to do her loan was at the time, which was probably, I want to say 2005-ish. I want to say that at that time, the banks were really iffy about people that were going to live together that didn't have a history of living together, which makes it really hard if you're engaged to get married and you never lived together. And now you're getting married and they're saying, well, are you really going to live together? And I think that they thought one of the sisters was just helping the other sister, and one sister didn't qualify with the other. So the difference is, somebody who is a mortgage banker or a mortgage broker, because they don't work at what we call a depository, which is a bank or a credit union, we have to go through a 20-hour class, which is pretty detailed on how to do loans. And after we take that 20-hour class, we have to take a pretty hard test. It's a national exam, and that national exam you have to pass with 75%. And if you don't pass, you have to wait a month. If you don't pass 3 times, you have to wait 6 months. So let me tell you, you have to know what you're doing if you have an MLO license. And depending on how many loans they've done and how long they've been in the business, they probably have a broker that's helping them. Whereas if you look at a bank or a credit union, you don't have to have that license. You just have to be registered. So that's some of the information that you need to know when you're shopping for a loan. The other part that you need to know is how to read a loan estimate. And we'll save the loan estimate, appraisals, and some more title insurance information for the next bonus video. So make sure that you like us, you subscribe, because not only if you subscribe, you're going to be notified if you do the notifications of whenever I'm going live or if I'm doing a specific type video. So good luck on all your real estate endeavors. Good luck if you're getting your real estate license. We're here to help you pretty much 24/7. We'll see you out there in the real estate world.